For most people, the idea of a free market feels almost natural. It is taught early, repeated often, and rarely questioned. Markets are supposed to be neutral arenas where millions of individual decisions collide. Prices emerge, winners are rewarded, and losers are punished. No referee, no safety net, just discipline. If you take risks and succeed, you deserve the profit. If you take risks and fail, you deserve the loss. This story is so deeply embedded in modern economic thinking that it feels less like a theory and more like a law of nature. The promise is simple and emotionally powerful. Free markets are said to allocate resources efficiently because they are ruthless. Bad ideas die. Weak companies disappear. Poor investments are punished. Through this constant cycle of trial, error, and failure, the system becomes stronger over time. Pain is not a flaw of the system. It is the mechanism that makes it work. Without failure, there is no learning. Without bankruptcy, there is no discipline. Without losses, there is no responsibility. This idea traces back to classical economic thinking, most famously associated with Adam Smith and later thinkers who argued that decentralized decision-making leads to better outcomes than centralized control. When individuals pursue their own interests, competition forces efficiency. Prices signal scarcity. Capital flows toward productive uses. In theory, no single actor is important enough to distort the system. Everyone is replaceable. Everyone is accountable. Over time, this philosophy became more than academic. It turned into a moral framework. Success in markets came to be seen not just as profitable, but as deserved. Failure, likewise, became personal. If your business collapses, it is because you mismanaged it. If your investments lose money, it is because you misunderstood the risk. If you go bankrupt, that is the market teaching you a lesson. The system itself remains innocent. Blame is individualized. You can see this logic everywhere in how financial losses are discussed. When retail investors lose money during a market crash, the response is almost always the same. You should have known the risks. No one forced you to buy. Markets go up and down. When small businesses shut down after an economic shock, it is framed as unfortunate but necessary. Creative destruction, economists call it. Weak firms exit, so stronger ones can take their place. The language is cold but consistent. Pain is the price of progress. This framing creates a powerful sense of inevitability. Markets are not just competitive. They are portrayed as impartial. They do not care who you are. They do not play favorites. They simply respond to information. Under this worldview, government intervention is dangerous because it interferes with price signals. Bailouts are morally suspect because they reward failure. Regulation is often portrayed as an obstacle that protects inefficiency and distorts incentives. For ordinary participants, this belief system shapes behavior in subtle ways. Individuals are encouraged to internalize risk as a personal responsibility. If you lose money in stocks, that is on you. If your startup fails, that is your lesson. If your pension underperforms, you should have planned better. The market is treated almost like a harsh but fair teacher. It does not hate you. It does not love you. It simply judges. This idea is reinforced culturally as well. Popular finance books celebrate entrepreneurs who took enormous risks and won, often glossing over the countless others who took similar risks and failed. Media narratives praise resilience and grit, implying that survival is proof of merit. Those who fall out of the system quietly disappear from the story. Their losses are not evidence of structural imbalance, but of individual miscalculation. At first glance, this worldview appears internally consistent. If everyone is subject to the same rules, then discipline is fair. But embedded within this promise is an assumption that rarely gets examined, that all participants face the same consequences when they fail. That failure is symmetrical, that the market's punishment is evenly distributed, regardless of size, influence, or interconnectedness. This assumption feels plausible when we look at small-scale examples. A restaurant opens and closes. A local investor loses savings. A small hedge fund blows up and disappears without headlines. In these cases, the market really does look brutal and impartial. No emergency meetings, no press conferences, no sudden rule changes. Losses are absorbed by those who took the risk. Because these examples are so common, they become representative in our minds. They shape our intuition about how the system works as a whole. We are trained to think that this is simply how markets behave at every level. Bigger risks mean bigger rewards, but also bigger potential losses. Scale, in theory, should not grant immunity. Yet this is where the promise begins to crack. The belief in free markets depends not just on competition, but on the credibility of loss. If failure is not allowed to happen at the top, the discipline that supposedly governs the system breaks down. But this contradiction is easy to ignore as long as we only observe the bottom layers of the market. For most people, the only failures they ever see up close are their own, or those of others like them. This creates a distorted perception. The market feels unforgiving because, at the individual level, it is. But individual experience does not reveal how the system behaves when the stakes become systemic, when losses threaten not just participants, but the structure itself. The ideology of free markets relies heavily on this gap between lived experience and institutional reality. There is also a psychological comfort in believing the system is fair, even if it is harsh. If losses are deserved, then success is meaningful. If the market is neutral, then there is no need to confront uncomfortable questions about power, privilege, or protection. Inequality becomes a natural outcome rather than a designed one. The rules feel impersonal and therefore legitimate. But legitimacy depends on consistency. A system that preaches discipline while selectively suspending it is not merely flawed. It is deceptive. And the first step in understanding that deception is recognizing how convincingly the myth of free markets is sold at the surface level. Because when markets are calm and failures are small, the story appears to hold. It is only when the system is stressed, when losses begin to cascade, when large institutions wobble, when the consequences of failure extend beyond individual actors, that we are forced to confront an uncomfortable question. If the market is truly free, who is it free for? That question marks the boundary between the idealized promise of free markets and the reality of modern finance, where freedom and discipline do not apply equally to everyone. When failure happens at the lower levels of the financial system, it is rarely treated as a crisis. It is treated as proof that the system is working. Losses among small players are not only accepted, they are expected. They are described as a necessary friction that keeps markets efficient and honest. In this part of the system, the idea of a free market is enforced with remarkable consistency. Consider the individual investor. When markets fall and portfolios are wiped out, there is no emergency response. No special facility is created to restore lost savings. No authority steps in to guarantee that retail traders break even. The dominant message is simple and repetitive. Risk was known in advance. Volatility is the price of participation. If you did not want a downside, you should not have entered the market. Loss, in this framing, is not a failure of the system, but a personal miscalculation. The same logic applies to small businesses. Every year, millions of firms shut down, often because of factors far beyond their control: shifts in demand, credit tightening, supply chain disruptions, or sudden changes in interest rates. When this happens, the narrative is rarely sympathetic. Policymakers and commentators speak in abstract terms about efficiency and reallocation. Capital and labor, they argue, must move to more productive uses. Businesses that cannot survive should not be protected, because protection only delays the inevitable and weakens the economy in the long run. This reasoning becomes especially visible during economic downturns. In recessions, small firms are often the first to collapse as credit dries up and consumers pull back. Yet their failure is rarely framed as a systemic threat. It is seen as painful but contained. Workers lose jobs. Owners lose equity. Communities are damaged, but the system itself is considered intact. There is no suggestion that the rules need to change to accommodate these losses. The market is simply adjusting. Financial institutions at the lower end of the hierarchy are treated the same way. Small banks fail with little public attention. Depositors may lose access to funds temporarily. Shareholders are wiped out. Executives are removed. Regulators oversee an orderly liquidation, and life moves on. These failures are often cited as examples of good governance. The message is clear: discipline has been applied. Moral hazard has been avoided. This pattern reinforces a powerful lesson. At the bottom, failure is individualized. Responsibility is localized. Consequences are absorbed by those closest to the risk. The system does not bend to accommodate them, and it does not apologize. This is what makes the idea of market discipline feel real. People can point to countless examples of individuals and small entities being allowed to fail as evidence that the market truly is impartial. Language plays an important role in maintaining this perception. Terms like creative destruction and market cleansing frame loss as productive rather than tragic. They transform bankruptcies and foreclosures into abstract processes, stripping them of human cost. When people suffer, it is unfortunate. When businesses collapse, it is necessary. When investors are wiped out, it is instructive. The system itself remains morally neutral. Over time, this framing shapes behavior and expectations. Small participants learn not to expect help. They internalize the idea that protection is not part of the deal. Risk management becomes a personal responsibility, not a collective one. If something goes wrong, the correct response is not to ask why the system allowed it to happen, but to ask what you personally did wrong. This mindset also influences how society reacts to loss. There is little public outrage when retail investors lose money in speculative bubbles. There is limited sympathy for entrepreneurs who borrowed too aggressively and failed. These outcomes are often framed as cautionary tales rather than warnings about systemic fragility. The pain is seen as deserved or at least unavoidable. Crucially, this tolerance for failure at the bottom helps stabilize the ideology of free markets. As long as small players are regularly allowed to fail, the system appears credible. It looks tough. It looks disciplined. It looks resistant to political interference. The everyday visibility of loss reinforces a belief that no one is immune. But this is a partial truth. The market's apparent cruelty at the bottom obscures a deeper asymmetry. Losses are permitted, even encouraged, only when they remain isolated. As long as failures can be contained, the rules are rigid. Bankruptcy laws are enforced. Contracts are honored. Prices are allowed to fall. The moment losses begin to cluster. However, the language subtly changes. What was once a personal failure starts to be described as a shock. What was once poor judgment becomes unforeseen circumstances. And what was once an acceptable casualty begins to raise concerns about confidence, contagion, and stability. At the lower levels, these concerns rarely apply. A single investor's collapse does not threaten the system. A small firm's bankruptcy does not destabilize credit markets. A local bank's failure does not freeze global liquidity. Because the impact is limited, the ideology of free markets can be applied without hesitation. This creates a quiet but profound divide. The rules of the game are strict and unforgiving where failure is cheap, and flexible where failure is expensive. Yet this divide is invisible to most participants because they only experience the part of the system where discipline is absolute. As a result, the myth of free markets is sustained not by universal fairness, but by selective exposure. Most people only ever see the version of the market that punishes them. They do not see what happens when the consequences of failure become too large to ignore. And it is precisely at that point when failure threatens not individuals, but the architecture of the system itself that the story of free markets begins to unravel. When failure moves up the hierarchy, the tone changes. The language of discipline, responsibility, and creative destruction quietly fades, replaced by a new vocabulary: stability, confidence, contagion, systemic risk. These words signal a shift, not just in rhetoric, but in rules. At this level of the market, failure is no longer treated as a lesson. It is treated as a threat. The clearest illustration of this shift came during the global financial crisis of 2008. In the years leading up to it, large financial institutions took extraordinary risks. They leveraged thin layers of capital on top of massive pools of debt, packaged fragile mortgages into complex securities, and distributed them throughout the global system. When the underlying assets began to fail, the losses were not contained. They spread rapidly across banks, insurers, pension funds, and money markets. At that moment, the logic of free markets should have been tested. If discipline was truly universal, the institutions that mispriced risk should have been allowed to collapse. Their shareholders would be wiped out. Their creditors would take losses. Competitors would acquire the remains. The system, after pain, would emerge stronger. That is not what happened. Instead, governments and central banks intervened on an unprecedented scale. Major banks were recapitalized with public money. Toxic assets were absorbed or guaranteed by the state. Emergency lending facilities were created almost overnight. In the United States alone, trillions of dollars in support through bailouts, guarantees, and liquidity programs were mobilized to stabilize the financial system. The justification was always the same. These institutions were not just banks, they were infrastructure. Letting them fail, policymakers argued, would have caused catastrophic damage to the real economy. Credit would freeze. Payrolls would not be met. Trade would seize up. The cost of intervention, however large, was framed as smaller than the cost of collapse. This reasoning introduced a concept that would come to define modern finance: too big to fail. Certain institutions, by virtue of their size, complexity, and interconnectedness, were deemed impossible to liquidate without endangering the system as a whole. Their failure was no longer a private matter. It was a public risk. The implications of this designation were profound. If an institution cannot be allowed to fail, then it does not face the same discipline as smaller actors. Its downside is capped not by law, but by expectation. Markets understand this. Creditors understand this. Executives understand this. The presence of an implicit safety net changes behavior long before a crisis ever arrives. This pattern did not end in 2008. It became institutionalized. In the years that followed, central banks expanded their role as backstops to the financial system. Quantitative easing blurred the line between monetary policy and market support. Balance sheets grew dramatically as central banks purchased government bonds, mortgage securities, and in some cases, corporate debt. By 2020, the logic was fully normalized. When the pandemic triggered a sudden halt in economic activity, markets seized within days. Instead of allowing prices to find a bottom through widespread liquidation, central banks intervened immediately. Interest rates were cut to zero. Massive asset purchase programs were launched. In the United States, the Federal Reserve went further, creating facilities to buy corporate bonds, including debt issued by companies with weak credit profiles. This was no longer a rescue of banks alone. It was a rescue of markets themselves. The message was unmistakable. Disorderly failure at scale would not be tolerated. Liquidity would be provided in whatever quantity was necessary to restore confidence. Swap lines between central banks reinforced this hierarchy on a global level. Major currencies were granted access to dollar liquidity, ensuring that large financial systems could continue operating even under extreme stress. Smaller countries without such arrangements faced far harsher constraints. Once again, protection followed size and systemic importance, not universal rules. Defenders of these interventions argue that they are pragmatic rather than ideological. The goal, they say, is not to reward failure, but to prevent collateral damage. Yet this distinction collapses under scrutiny. When losses are absorbed by the public while gains remain private, incentives are distorted. Risk-taking is encouraged, not discouraged, at the top of the system. Executives at large institutions are rarely held personally accountable for these failures. Shareholders may suffer temporary losses, but the institutions survive. Management teams often remain in place. In some cases, they are rewarded during the recovery that follows. The system sends a clear signal. Scale provides insulation. Contrast this with the experience of smaller actors. A failed entrepreneur cannot appeal to systemic importance. A small bank cannot claim that its collapse would destabilize global markets. A retail investor cannot argue that their portfolio loss threatens confidence. Their failures are allowed to play out fully, without intervention. The free market, in this context, reveals its true boundary. It operates strictly where losses are manageable, where failure can be absorbed quietly, where pain does not threaten the architecture of finance. Once that boundary is crossed, the market is no longer allowed to function on its own terms. This selective suspension of discipline exposes the myth at the heart of modern finance. The system does not treat all participants equally because it cannot afford to. It relies on a tiered structure in which some actors are essential and others are expendable. The rhetoric of free markets masks this hierarchy, but does not eliminate it. What emerges is not a free market, but a managed one. Risk is privatized during expansions and socialized during crises. Profits accumulate at the top, while losses are distributed across society when they become too large to contain. This is not an accident. It is a logical outcome of a system that values stability over consistency. The result is a deep asymmetry. Those with the greatest capacity to influence the system also enjoy the greatest protection from it. Those without that influence are left to bear the full weight of market discipline. The rules appear universal, but their enforcement is conditional. By the time this pattern becomes visible, it is usually too late to debate ideology. Decisions are made under the banner of emergency. Markets are stabilized. Institutions are saved. And once the crisis passes, the language of free markets quietly returns until the next time it must be suspended again. At that point, the question is no longer whether free markets exist, but whether they ever applied to everyone in the first place. By the time we reach this point, the pattern is difficult to deny. What is commonly described as a free market is, in practice, a layered system of permissions and protections. The rules do not disappear during crises. They are selectively rewritten, and the power to rewrite them belongs to a small group of institutions whose survival has been defined as synonymous with the survival of the system itself. Modern finance is not governed by a single set of neutral laws. It is governed by thresholds. Below a certain scale, market discipline is absolute. Contracts are enforced. Losses are realized. Bankruptcy is final. Above that scale, discipline becomes conditional. Losses are negotiated. Time is bought through liquidity. Failure is reframed as instability rather than incompetence. The difference is not moral. It is structural. This structure did not emerge accidentally. Over decades, financial systems became increasingly concentrated. Banks grew larger through mergers. Markets became more interconnected through derivatives, clearinghouses, and global capital flows. Governments, in turn, became more dependent on these institutions to finance deficits, manage debt markets, and transmit monetary policy. As dependence grew, so did the cost of allowing failure. In this environment, the concept of a truly free market became incompatible with the goal of stability. A system built on leverage, speed, and interconnection cannot tolerate large, uncontrolled collapses without threatening itself. Intervention, once considered an exception, became a standing feature. Safety nets expanded quietly, justified as temporary measures, then normalized as permanent tools. Yet the language of free markets never disappeared. It remains useful. It disciplines those without protection. It frames inequality as outcome rather than design. It encourages individuals to accept risk as a personal burden while obscuring the collective guarantees that underpin the system at the top. The myth persists not because it is accurate, but because it is functional. For ordinary participants, this creates a dangerous mismatch between belief and reality. People are taught to behave as if they are operating in a neutral, unforgiving environment, while unknowingly participating in a system where outcomes are heavily shaped by institutional power. They take risks assuming symmetrical consequences, when in fact the asymmetry is built in from the start. This does not mean markets are entirely rigged or that outcomes are predetermined. Prices still move, assets still collapse, companies still fail, but the distribution of consequences is uneven. Losses are tolerated only where they do not threaten the system's core. Where they do, the market's verdict is postponed, softened, or reversed through policy. Understanding this changes how we interpret financial crises. They are not moments when free markets fail, followed by unfortunate but necessary intervention. They are moments when the underlying structure becomes visible. The crisis reveals who is protected, who is exposed, and whose failure is considered unacceptable. It also changes how we think about responsibility. If risk-taking at the top is backed by implicit guarantees, then calling the system meritocratic becomes misleading. Success is not purely the result of superior judgment, just as failure is not purely the result of poor decisions. Both are filtered through a framework that allocates protection selectively. The uncomfortable truth is that modern finance operates less like a free market and more like an insurance scheme with unequal coverage. Some participants pay full premiums in the form of real losses. Others enjoy protection they did not explicitly purchase, funded indirectly by the broader economy. This is not a conspiracy. It is a consequence of how stability is prioritized over fairness. Once this is recognized, the narrative shifts. The question is no longer why markets feel harsh to individuals, but why they feel forgiving to institutions. It is no longer why small players must endure discipline, but why large players are shielded from it. These are not anomalies. They are features. The myth of free market survives because it simplifies a complex reality into a moral story. It tells us that outcomes are deserved and that the system is impartial. But modern finance does not operate on moral symmetry. It operates on risk containment. Those who generate risks that cannot be contained are protected from the consequences of those risks. This realization does not offer easy solutions. There is no simple way to remove safety nets without inviting instability, just as there is no easy way to maintain them without reinforcing inequality. But clarity matters. Seeing the system as it is, rather than as it is described, is the first step toward honest debate. In the end, the most important distinction is not between free markets and regulated ones, but between who is allowed to fail and who is not. Freedom in modern finance is not universal. It is conditional. The market is free to punish those who can afford to lose.